Hello everyone, welcome back. This is going to be a pretty important video to pay attention to. You can use this exact theory to filter out trades. You can use this theory to make your very own models. You can add this theory to your current models. You can do all sorts of things. Ultimately, learning this theory is going to help you analyze price action that much better. Another tool that can be added to the toolkit, to the tool belt, to the toolbox. Okay? This can work on any time frame, on any candle. Time is fractal in nature. If you want a more in-depth analysis or explanation on this theory, be sure to join the TSR Premium, where I am releasing more in-depth content alongside all the other extra lectures and private masterclasses that have been released to the TSR Premium members. Other than that, I would like everybody on my YouTube channel to know that I do have a one-on-one mentorship running. We are looking for a second batch of people to take on. The link is in the description. And one thing to point out and mention is that I promise to you and guarantee that you will become profitable in 90 days or less, or I will personally work alongside with you one-on-one until you become profitable. That is the guarantee that we have with the one-on-one mentorship. So let's dive into the topic of today. Very straightforward topic here. We're going to be talking about the open. How important exactly is the open of any candle? Whether it be the daily candle, whether it be the weekly candle, the monthly, the yearly, the 4-hour, the 1-hour, the 15-minute. Obviously, I am teaching this not to be used on the 15-minute time frame, rather to be used on a 1-hour, a 4-hour, a daily, and weekly time frame. Exactly what I will be explaining in this video can be used to further refine your entries and just maybe, include or expand your knowledge and add in another entry model to your system. Alright, so let's get into this. You can use this in any hour. I'm specifically going to be using the 9 a.m. and the 10 a.m. hour. Majority of these examples are going to be shown with the 9 a.m. hour. Firstly, before you start to understand how we will be using this hourly open, the open of the hourly candle, you must understand what is the premise behind this. The premise behind the hourly open or any candlesticks open is to step number one, open, accumulate orders, manipulate orders out, expand, distribute, retrace, and close. That is the premise behind any candle. When we expand, after opening and manipulating, we see the distribution. We see a displacement of that opening candle, opening price. That is the confirmation that you want to be looking for in order to enter your trade in the opposite direction. What do I mean? Let's dive into this example stemming from Thursday, April 10th at 9 a.m. We have the 9 a.m. open. So this is the 10 a.m. candlestick open and the 9 a.m. candlestick close. This is the 9 a.m. candlestick open. What do you notice here? Price action is consolidating above the open. We have very little to no price action below the open. What happens as soon as we test going deeper below the open, We displace what? This specific low, the low that took out a high. This is on a 1 minute time frame. The low that took out a high was broken through, displaced while coming through the hourly open. We now know on the retracement, you can be looking to enter within specific PD arrays on your left-hand side to then target the opposing end of any specific range that you would have been trading. In this example, you could have used this low right over here as a potential target. Alright, and now if you dig even deeper, there were other targets as well. However, this low right here would have been the valid target. Alright, the trick here is to merge this analysis with any previous knowledge that you have of the charts. Alright, for example, if price action is bearish, if we took out a 15-minute or 1 hour CRT high, and you see this formation with the hourly candle, you are bearish. Let's take a look at another example from the previous day. We are on a 1 minute time frame. What do you notice here? Price action expanded to the upside, retraced once to the hourly open, immediately expanded to the upside. Right here, I personally would not have been looking for any entries. 9 a.m. candle. What happens in the 10 a.m. candle here? If we simply clone this, push it over, we have the hourly high and the hourly low. Where is the hourly open? Right over here. We have that hourly open. This is the 10 a.m. hourly open. We are turtle souping the 9 a.m. highs, the previous hourly highs. Turtle souping those highs, immediately retracing, and then displacing through the hourly open. What do you notice? Price action was above the open. We had little to no price action below this open. As soon as we come down, we are looking to see whether we wick coming back up or whether we displace the open. In this scenario, we displaced the open. How did we displace the open? We took out a low and closed below this low that rejected a high. After rejecting that high and closing below this low, we notice fair value gap formations, which further allow you to confirm that this is the correct setup. Displacing, retracing into the entry, consolidating inside of the entry to then expand lower. And that was the idea behind this hourly open here. So yes, you would have had no setup to enter in the 9 a.m. hour. However, during the 10 a.m. hour, you would have indeed had a setup. So if you like inverse fair value gaps, you had one right here on the 1 minute time frame. You would have entered this trade as soon as it was tapped into, right over there, with a stop loss either at these highs or the high of the candle that created the inverse fair value gap. And where would you be targeting? Any points of liquidity. So for example, you can have final TP at the 9 a.m. lows, which were never hit. However, TP1 was in fact hit, the midpoint of this specific range right over here. You can also have your take profit set at this low right over here, this low right over here, and this low right over here. All right, so that is how you could have used the 10 a.m. open for that trade. Now, let's take a look at yet another example. Coming to the previous day here, we can see almost the exact same thing happening. Price action opens, taps below the hourly open, and immediately expands to the upside here. What do you notice in the next hour? So if we go ahead and clone this, drag it over, adjust it to the high and the low, what do we see here? We have the 10 a.m. open. As soon as the candlestick opens, we are taking out the previous hour's high. We are then consolidating above the open of this candle. Barely any price action below, and every time we come to test it, we wick up. Test it, wick up. Coming back down, failure swing low, wick back up, and then finally, what do you notice? We close below the open, forming a fair value gap and breaking market structure. Important. So you are not bearish when this candle right here forms. No. You are bearish when this candle right over here closes. This specific candle right here. Why? The reason you are bearish from this candle and not this candle is because this candle confirms the fair value gap. This candle confirms the market structure shift. All right. Why is this the market structure shift and not this? Because this low was the low that turtle souped the high. What high? This high. All right. We broke the structure and formed a fair value gap that is displacement below the open. We then retraced into that fair value gap and started to pursue lower prices. How would you have entered this? If you are using CRT, you can look for an order block entry. If you are not using CRT as your entry, you can use this specific fair value gap right over here. We have no 1 minute fair value gaps above. So you would drop your stop loss to the candlestick's high, not that created the fair value gap, but the first candle, part of the 3 candle fair value gap formation's high, right over there. Your TPs would have been at this candle's low, and the opposing end of the 9 a.m. range, which would have been this candlestick's low right over here. Now, according to CRT, your first take profit is at the midpoint of this range, the 9 a.m. candle's range. And the second take profit is at the 9 a.m. candle's low. This was the trade setup that you would have gotten using the open as your entry confirmation, and when to anticipate expansion in the opposing direction. Now, it's not always going to be picture perfect like this. Hopefully we can find an example where it doesn't quite work out so perfectly. I am indeed showing you guys examples here where price action doesn't give you that displacement. And what do you do here? You wait. You do not do anything. You sit on your hands. Yes, you're going to see people on Twitter entering long. Yes, you're going to see famous influencers showing off their massive profits that they got in this long swing. You are not interested until you see what you want to see. Displacement past the open, anticipating what? Let's just be real here, anticipating the market maker model. Let's take a look at the previous day's example. So I am not cherry picking anything here. I am showing you every single previous day of this week and the previous week as well. And if you go back test it yourself for the previous weeks, you can notice the same exact thing. And this works on every single time frame. What happens in this example here on Monday, April 7th? we have expansion to the downside as soon as the 9 a.m. candle opened. And then all of a sudden, we tapped into a specific level, turtle souping a low, and started to expand. What do we notice at the at the end of the 9 a.m. candle? We displace through the open. Important, that is key. We displace through that open, and immediately, let's clone this. And extend this through. And let's mark out the 10 a.m. open. As soon as the 10 a.m. open occurred, you first noticed that we displaced the previous hour's open. We must get a retracement to where ideally that open, to then catch a PD array to enter long. Where is this open going to be? Below the current candle's open. What do you notice here on a 1 minute time frame? We retrace into a PD array, expand to the upside, and immediately displace that range. We formed a lot of fair value gaps here. Going long up here with a retracement down on a 1 minute time frame is not the smartest idea. You would have not found any entry here unless you were entering on this retracement, which ideally would have been used by looking at this hourly open here. I personally would have skipped out on this trade. I wanted to wait for expansion and then a retracement right away. We never got that. Price expanded and then completely reversed right away. All right, so that's a good example to look at here, where we took out this level, clearly accumulating, manipulating, and then expanding, retracing where below this open into the previous hour's open, and immediately reverse into the upside. Let's take a look at the day prior. So we have the hourly open. What do you notice here? Very straightforward, guys. Extremely straightforward. Let's mark this out to the high. Mark this out to the low. And if you guys notice here, these are the 8 a.m. highs. Right, the 8 a.m. hour opened up right over here. We created the high right over here. We took out those 8 a.m. highs, but we're not going to look for our entry here. What are we going to wait for? Well, we are bearish. So what's the next step? We want displacement below the open. Do we get it? Of course we do. Forming a fair value gap below that open is in fact displacement. Displacing that and respecting the fair value gap. Look at the bodies, not the wicks. Bodies, not the wicks. Respecting this fair value gap that formulated the displacement past the hourly open. We were bearish ever since this fair value gap was created, ever since the 9:13 hour. Then what continues to follow through? As soon as we hit this specific low right over here, let's mark this out with a red line. This is the absolute confirmation that displacement was confirmed with the market structure shift. Why is this the market structure shift? The low that rejected a high into the previous 1 hour's high was broken through with the close below and fair value gap creation past the hourly open. Retracing into your fair value gap or order block or breaker or whatever, retracing, finding your entry, and then your targets. Your targets are based on the technicals, not what you want it to be. Targets could have been the low and the midpoint of the previous hour's candle. Or you can be using lows, swing points, TP1, TP2, TP3, and etc. TP4. Right? So that is another day that the opening theory can be used. All right. Let's take a look at the day prior to this, and I'm doing a lot of these examples here with you guys because, well, first off, I want everybody to know this. I personally have not been speaking too much about this because I was running tests. Now, yes, I was running tests. I was not executing this on my live account. This was only executed through backtests, okay? And that means that I was still taking trades that were going against this theory, knowing it fully well. And while I was trading live, I realized, hey, that hourly open theory is going to do great. And as soon as I start applying that, it will start doing well. All right, so let's see what we notice here. Let's just fix this to the 10 a.m. hour. The 1 minute time frame and the hourly open. What do? First off, we take out the 8 a.m. lows. Right over here, 8 a.m. low. Specifically 8:59, creating that low. Taking out those 8 a.m. lows. What happens almost instantly? As soon as we take out that low and move to the upside here, we don't get the close above the open. Above this high that rejected a low. No, we do not. However, once this candle closes, displacement occurred. Why? We expanded lower, manipulated, rejected all liquidity below this hourly open, expanded to the upside, retraced into this order block, expanded higher, closing above this high right here, market structure shift, forming fair value gaps as well. This is the displacement past the open. We then see the retracement into the PD arrays. Entry long, targeting where? The midpoint of the previous hour's range and the opposing end of the previous hour. Or any technical imbalances such as 1 minute highs, swing points. You could have taken out some more here, some more here, and ultimately some more right here. All of your TPs would have been hit. Yet another example of this opening theory working out well. Okay, this literally will work every single day as long as you are not forcing trades. Now, here's a good point to be made. If, for example, we are doing this on this specific day, price action is consolidating here below the open, rejecting that open, then breaking through the open, coming back to the open, then breaking higher, breaking structure, forming fair value gaps. If you're not confident that this is a displacement, don't take it. And then study. If you should have taken it, why should you have taken it? If you shouldn't have taken it and price reverses, why shouldn't you have taken it? All right. Next, let's take a look at the next example. This is probably going to be the last one. I think I'm really starting to bore you guys right now. This was a pretty in-depth lecture. Strictly backtests or hindsight knowledge, showing you exactly what this actually looks like. Okay, so let's just adjust this to the low and to the high. This looks like a perfect example of where you would have never gotten an entry. And moves like these will always piss you off and might force you to overtrade and take unnecessary positions. What happens? Price action moves below the open. If you're using the previous example to execute this trade, you would displace the open. Fair value gap created, displacing the low right over here, specifically low that took out a high, displaced, closure below here. You want to tap into this fair value gap or another PD array, which we did end up hitting with this 908, 907 retracement. Your first TP would have been here. And your next TP, ideally, we don't have another low, but we have the low of that fair value gap right over here. Key level could have been right at this level. Then what happened? Prices completely reversed on you. Displaced in the opposite direction. So now we know for a fact, this whole move down, we have barely any price action above the open as price is moving lower and we start expanding higher. We close above the open. We know, okay, we spent all this time below the open, and now we're starting to expand higher. This has likely confirmed the low, and this will be an open, low, high, close candle. Displacement past the open. We have fair value gaps created, but no entries. Fair value gaps created, no entries. And then we see the retracement. I would have never entered on this fair value gap. Why? The R to R with all these other imbalances is simply not there. That's all. Right? So this is an example where the theory functioned perfectly, but you would have never actually found an entry. All right, so that's going to conclude the opening theory lecture. I hope you guys enjoyed this. And as always, if you want more in-depth information just like this, be sure to join the TSR Premium Discord. And if you're looking for direct one-on-one coaching where I can literally force you to become profitable, then hit the other link, the second link down below, which will bring you to the one-on-one mentorship landing page. With that being said, I hope you guys all have a nice one and good luck trading.